Alrighty. Well, good afternoon, ladies and gentlemen. My name's James Marley and I'm a co-founder of Livewire Markets. And I'd like to introduce Hamish Douglass, who's the Chairman and Chief Investment Officer of Magellan Financial Group, or Magellan Asset Management. Hamish, good afternoon. Thanks for your time. I really appreciate this opportunity to speak with you at such an interesting moment. As we discussed beforehand, we've kind of timed the pants off it.
Well, James, thank you very much for having me. It's certainly been an interesting 24 hours. We may still have another sort of 12 hours or something to go, but I think the whole world's been watching, and there's been some sleepless nights for many people. It's obviously been important for markets as well, so we've been watching it closely. But I guess we're lucky. We've almost timed this perfectly.
Yeah. And to all of those viewers, from whether you're a Magellan shareholder or a Livewire reader, we appreciate you taking the time to tune in. We really value the support that you provide us. I'm just going to give you a quick overview on the session today, how we're going to run it. We're going to do about 25 minutes with Hamish and I. I've got a few questions that I'm going to run through with Hamish, and then really we're going to open up the forum for you to ask Hamish the questions that you want answered. I think there's a good chance that we will get more questions than we can get through. So what I've done is I've opened up what's called the upvote system on the Q&A panel. So you can jump in at the bottom of your screen. You should see the Q&A toggle. You hit that Q&A, and if you see a question in the queue that you really like, give it the upvote, and it'll let me know that that's the question that people want to see answered. So hopefully we can get to the points that are most important to you. But we are going to be asking Hamish a bunch of questions this afternoon, and I thought, before we put you under the spotlight, Hamish, we might give you the opportunity to ask all of the participants on the webinar a question. And so I'm going to launch a poll for all of you on the webinar. We'd love to hear how you're feeling. And Hamish, the question that you wanted to put to people was really around how they are feeling, given that the RBA cut interest rates to emergency settings, again, or deeper into emergency settings earlier this week. Now, first of all, can you tell me why this is a question that you wanted to speak to investors about?
Yeah, James, I think it's a very interesting world investors are now living in, particularly people who are closer to retirement or in retirement. You know, the RBA has just cut interest rates for all respects to zero, and many countries in the world have cut interest rates to zero. And the RBA is saying we're going to be here for at least 3 years. And who knows, we could be there for much longer with very, very low interest rates, effectively earning nothing on your deposits. And deposits has been an important part of people's income. And even what you can earn on like hybrid securities is much, much lower than it's been in the past. But then when you look at your equity book, much of your equity book is probably looking pretty good. It's recovered most of its losses since March and is probably near its all-time record levels. I guess it depends who you invest with, but if you got some good equity investments, you may be looking good on your equity investments. But when you look on your sort of safer investments where you've been harvesting cash for your income, the outlook is pretty dire. So, you know, how do you trade off where the equity markets may be looking good, but the sort of safer part of the income part of your book is looks really, really hard moving forward. So how do you deal with this sort of opposing sort of forces in your investment portfolio?
Yeah. Well, Hamish, I'll just give you a quick snapshot on what the audience are feeling. 20% have said that they're really concerned about this issue. About 50%, 55% are moderately concerned. 20% are not concerned at all. And 60% think it's a recipe for disaster. So I guess that's given you a bit of a barometer on the audience. It's definitely an issue that's on their mind, but I guess, maybe people are becoming a bit accustomed to this environment.
Yeah, there's quite a dispersion. It'd be very interesting to know by sort of people's demographics and things of where those votes were coming in. But it's a new world. Really, when you go for the last, almost 40 years, you've been able to get pretty safe, secure interest on your sort of term deposits and within your hybrid securities portfolio, or even investing in property trusts looked pretty safe, but a lot of the property trusts have been hammered. A lot of these income sort of products are challenged, and how do you shape that moving forward? So it's it's a dilemma. But there's no quick out to this, I have to tell people.
Okay. Well, let's get into it. US election, it's the topic du jour. Your first challenge as part of this webinar was to describe the investment implications from an investor's perspective, describe the implications in just one sentence. So away you go.
Yeah, I would say this outcome is the Nirvana outcome from an investor's perspective. Even though we don't know precisely who the president's going to be, the outcome is the Nirvana. Almost the perfect outcome from an investment perspective has been the outcome of this election.
Can you dig into that in a bit more detail for me?
Yeah, and I would describe what I dig in. I'd call it is we've got the ultimate check and balance here, whoever is the president. I think it's likely that Biden is going to be the president where things sit today. I'd probably put that as a very high probability. If you look to betting markets, just at the moment, you see is a very high probability. He's at 264 electoral college votes. He only needs to pick up either Nevada or Pennsylvania. You know, I suspect he's going to pick up both of those states, but I don't know for sure here. And the reason why I call it the Nirvana situation is it doesn't look like the Democrats have got the Senate. If they magically pull out the Senate, it's probably they'll only get 50 seats there. We won't know that till January. There's a runoff election in the Senate, but I don't think they're going to get there. But even if they did, we're not going to have this sort of magical blue wave with a big sort of swing in the Senate, and means they're going to get rid of this rule called the filibuster and give the Democrats almost unlimited power to pass sort of sweeping legislation. If the Republicans keep the Senate, as I think they will, there'll be no tax rises. There'll be no massive regulatory reform. There'll be no big left agenda here. So the check and balance is going to be in. And if Biden gets in, I suspect we're going to have a more sort of moderate discussion globally. We're going to have a more normal dialogue about sort of foreign policy and global institutions, and markets will like to hear that. But if Trump gets in, there's going to be a check and balance as well, because the Democrats are retaining control of the House of Representatives in Congress, and therefore Trump won't be able to pass sweeping legislation. So there'll be more of the same. There'll be no rising taxes, but no sort of radical changes. We'll have tweets and everything else going on if it's Trump. But if it's Biden, which I think it most likely will be, we'll probably have a calmer sort of global perspective here, but no radical agendas. And I think you're seeing that in this very strong market reaction. You saw, notwithstanding we didn't have an election result, and people were predicting chaos if we didn't have an election result. And but it was really the Senate result. And I always told people, you need to watch the Senate here. That is going to be the thing the markets have been watching. And I think it's a Senate result has given the markets this huge sigh of relief. As I say, it's the check and balance in place. We're going to get nothing radical on if it's Trump or Biden. As I said, it's probably going to be Biden. But even if it's Trump, I think the markets are going to be fairly calm. I think the markets would have a slight preference over Biden, given the Republicans in control of the Senate, just because things may be a little bit calmer. But either outcome is going to be fine for markets here on in.
And Hamish, from a Magellan perspective, will you sit down with the members of your investment team and are there likely to be tweaks and changes to your portfolio as a result of this outcome? Are the flow-on effects material enough to influence a tilt in the portfolio?
Yeah, actually, we were never that concerned about the US election. We'd always said the biggest outcome would be a big win in the Senate where they could look at the filibuster. And therefore, we'd really start thinking about what type of legislation could go through. And we kind of had gone underweight healthcare. And you can see healthcare stocks perform very strongly today as that sort of relief came in. But we're about to wade into healthcare just because that outcome has gone off the table, that risk has gone down. Probably not. We're going to look at it, of course, closely. But the main thing that's going on, and we can't forget this, it's still the pandemic. You know, the election risk has now passed us by. It's been the Nirvana outcome for markets, but we've still got the pandemic and we've got these vaccine trials that are coming in. The outcome of these vaccine trials are really going to tell us the way forward. I think we're quickly going to move past US politics as being the major driver here. And now back to the pandemic is the big issue for global markets.
Okay. Hamish, I've got a question here from Alex Hunt that's got a lot of support from other people on the webinar, and I think while we're talking politics, it's a good one to answer. Alex asked, does a potential Biden win in the presidency change the US-China relationship? And I think it's a great question.
I think it changes it somewhat, but not in the long term. I think we may get back to some sort of diplomatic setting. I think Biden will be striving to find some common ground, maybe on issues like attacking the pandemic, maybe on issues like climate change, where a dialogue starts becoming between the nations. It will be interesting to see if China gives something on trade and other issues in order to keep that dialogue. Effectively, Biden can have some wins on the other side. But the fundamental tensions between China and the United States are not going to disappear. They're fundamental, they're bipartisan issues in the United States. So you're not going to suddenly find Biden just backing off some of the fundamental issues. But I think the way it gets attacked, there'll be more diplomacy, there'll probably be more dialogue, there'll be some common ground found. But we're not going to have these tensions just dramatically disappearing about state sponsorship, about cyber theft of industries, about the debate on globalization is obviously a big issue for the Democrats and also for the Trump base. You know, Biden wants to bring the country together. There's a lot of people on the other side of the aisle who feel very strongly around China and what it's done to American jobs. So yes, I think there's going to be a calmer sort of discussion between the nations, but these tensions are not going to go away. China is a rising power. The US has not faced an economic equal literally in its existence. You know, when it was battling the Soviet Union was an ideological foe, but it was never an economic foe. China is both an ideological foe and an economic rival. And that's what makes this so different. And that's not going to disappear. The rise of China is not going to be stopped. The United States is going to be in constant tension with China, despite the Biden presidency. But I think we're going to probably have more dialogue occurring, some common ground, as I say, occurring. But we shouldn't just assume we're in clean waters and there's going to be no tension between Australia and China, or the US and China. China is rising. And it's becoming more assertive, and that's causing challenges for countries like Australia and the United States. But I suspect there will be more dialogue occurring under a Biden approach to this than the Trump approach to it. But let's see. Okay,
we've got a couple of other hot questions coming through while we're just on this topic, so I might just knock a couple off while
Absolutely.
we're.
They're probably better questions than yours anyway, James.
Oh, thanks, Hamish. Yeah. No, they're good. They're good questions. So I think this one is from Nick, and it's really around if there are any sector beneficiaries under a Biden win. You know, are there sectors that you think would have a preference with Biden in power?
Yeah, well, first of all, I think we have to distinguish between just Biden being in power and also the situation we find ourselves in with a split Congress. Here. The split Congress means we're probably not going to get legislation that gets agreed on regulating technology, for instance. So you know, the change to what is known as Section 230 that could have dramatically affected Facebook, the effect of getting Republicans and Democrats to agree on legislation on what that looks like, given they don't like it, but they have completely opposing views on how to regulate that. So you've seen things like Facebook have very strong reactions overnight and really discounting the possibility of sort of legislation. So I'd say that's more of an outcome of the election, of how the cards fell, rather than a Biden presidency. The Biden presidency, of course, he's going to try and push climate change as an agenda. There will be reversals of executive orders. The stimulus bill is going to be very interesting to see how far they can get of infrastructure investments, particularly green infrastructure investments. You know, how much Mitch McConnell, who's going to come to the table as the leader of the Senate on the Republican side. He's actually come out very early today and said stimulus is going to be our first side of it, but you know, there's going to be a real negotiation occurring there. So, you know, things like utilities could be beneficiaries here under a Biden administration, because they could have massive investment programs effectively taking out coal-fired generation and replacing it with cleaner energy. And that's been occurring, by the way, in a lot of states, but that could be accelerated. That was getting a real trade that was going on pre-election here. But I think ultimately from stocks, it's going to turn to the economy. At the end of the day, it's going to come to the stimulus, and it's going to come to the pandemic. And the pandemic is a medical issue, ultimately a scientific issue. It's really about therapeutics and vaccines, ultimately to get an exit out of this sometime next year. It's outside the politicians' controls. I think they can do better things to roll it out efficiently, coordination. But we need scientific breakthrough here at the end of the day, and that's going to drive the economy, and ultimately the economy will drive stocks here.
Okay. Hamish, for all those listeners with the questions, we're going to come back to questions. We've got plenty of time in the second half of the webinar. A question that I wanted to ask you, not directly related to the election, but I think very topical in 2020, was around these transient versus structural trends that have been topical and have emerged and we've seen COVID be a catalyst for them. I was really keen just to get your take on which of those powerful structural trends do you think are going to remain in place, and which of the ones that have emerged this year are more transient? We're talking about things like the work from home, online shopping, digital payments, move to the cloud, all of those sorts of things.
Yeah, this is a really good question. Obviously, something we've been thinking about a lot, and I think investors around the world have been thinking about a lot. You know, you've seen a lot of accelerations in trends, both winners and losers. By the way, you know, some of the trends are pull forwards of existing trends. You know, the e-commerce trend, as people were forced into shutdown, and people probably trying e-commerce shopping on platforms that they haven't tried before and found the convenience of that. You know, restaurant deliveries, eating at home trends where we've seen eating at home again is something I'd say may well be transient. It may well just be the situation we've been in, but once we free ourselves up, are people going to stay cooking at home as much? Are they going to have as much home delivery as they've been having? That may be more transient than structural, but e-commerce is definitely structural. I would say streaming, more and people signed up to streaming services around the world. I think that's an acceleration of a trend. Cloud computing, you've said absolutely. Organizations have found in the world that they want more resilience, and the benefits of moving to cloud-based computing in the world. We're living in a cloud computing world at the moment. We're on a Zoom call here. I think there's been adoption of more and more productivity software, but a lot of these trends were already happening. The eating at home trend wasn't happening. The break we've had on global travel is going to be very interesting coming out of the global travel situation. I think leisure travel is going to come back, but corporate travels, because of the Zooming world, people have worked out that it's incredibly efficient that you can do business now on video calls, and you may not need to travel. So it's going to be interesting to see how permanent the shift is in terms of moving to sort of a virtual meeting world from a physical meeting world, and how much that affects things like corporate travel in the future. Work from home, again, is a forced situation we've been put in. It's led to a lot of flexibility, but it's not perfect. And I think it's going to find its equilibrium. So I think part of it is transient, because I think a fair more people are going to work from home than where it's going to settle in the future. But there's going to be a permanent lift from work from home from where it was previously. It's hard to gauge on this travel and this work from home environment is where it's going to settle. That is a great unknown. If I had a crystal ball, you could make an awful lot of money. If you knew that precisely, you could make some wonderful travel investments if you knew that ball, where that ball is going to land. We just don't know where that ball is going to land at the moment, and it's estimations, guesstimations, speculation of where those balls would happen. And the other thing I would say about some of the pull forward of demand, you have to be quite careful that you don't extrapolate that this pull forward is going to keep occurring at its same rate. We could have brought forward a few years of demand, and then we could go into a flat period after this because it's been a pull forward rather than a permanent acceleration of existing trends. But absolutely, on balance, there's a lot of acceleration and bring forward of trends that were happening. There are things that are somewhat permanent. I think real estate, there's certain real estate sectors around the world, particularly in retail real estate, as you're moving more and more online, the productivity of physical real estate is going down, and that's going to have to affect rents in physical real estate in the retail sector in the future. But that trend was already happening. It's just becoming more apparent because of what's occurring.
Hamish, I'm going to take another question because it's by far and away the one that people seem to want to have answered. It's from Scott. At what point does the negative second and third waves in Europe and the USA from COVID, at what point do the economic impacts play out in the share market? We're seeing the case numbers spike up, almost rallying in tandem with the equity markets. Is there a moment where there's a reality check there?
Yeah, the answer to that, James, is I don't know the answer. And we have to be honest. Of course, we can all see the spikes that are happening. As they go on, it's more likely we're going to get more shutdowns in the Northern Hemisphere. And that's really a capacity question in the healthcare systems, how they trade off the jobs versus lives effectively. And that really comes down to a capacity in the healthcare system and a forecast from the medical experts of when they need to shut down. Ultimately, is that going to impact economies? The question is yes. Can it be offset? Well, if we get more stimulus, it can be offset. Is it going to have a major effect on let's say, the equity markets where we're all focused here? It really is going to depend, I would say, on the vaccine trials. If these vaccine trials, and we've got 4 major trials using 2 different forms of technology here. One form is the more traditional pathway for a vaccine. Johnson & Johnson and Oxford University with AstraZeneca have got 2 advanced phase 3 trials under the traditional pathway. The other one is called messenger RNA vaccines. That's what Pfizer, BioNTech and Moderna have under that. If you get a failure in each one of those pathways, I think we could get a major reset here about expectations and being ahead of ourselves, because people can see this second wave. They know it's going to last throughout the winter in the Northern Hemisphere. But if we have success in these trials and they expect in March or so we're going to start rolling out vaccines, I think the markets are forward looking and will look through those shutdowns through the Northern Hemisphere winter. But if these vaccine trials fail and we then don't have any clarity of where the exit point could be from this pandemic, and we're shutting down economies, that is when markets could really get spooked. So I keep saying it's a scientific question. The question you're asking here, why are markets kind of looking through these shutdowns at the moment? They get a little bit spooked on a few days because there is still a high expectation on these vaccine trials. Do we know what's going to happen in them? We have no idea what the outcome's going to be, and neither do the companies, by the way, at this point.
Yeah. Hamish, you alluded to it a little earlier. I guess the pull forward of demand for streaming services. I've been listening to a few of your podcasts as I make my way up and down the coast to and from Sydney, and you've alluded to a new investment in a streaming service. I'm going to hazard a guess that it's Netflix. You may or may not want to confirm that for me, but perhaps you could tell me the thesis and why you're drawn to the streaming sector in that particular part of the market.
Yeah, well, Inspector Clouseau, I'm not going to confirm nor deny whether your sort of deductions are the right deductions on exactly what investment, but we have said we've made an investment in a streaming company, and obviously we would follow a company like Netflix very closely. So what would be the case for a video streaming? There's obviously different forms of streaming businesses, music as well. But if you take one of the big platforms like a Netflix in the video streaming, in the long form video streaming business. There is a massive shift going on globally, how we get entertained by long-form video. Traditionally, we watched it on broadcast television. They were typically oligopolies in every country around the world, and then you had oligopolies or monopolies in pay television around the world. Those industries are literally going to cease to exist in the next 5 to 10 years, and all that viewership is going to be shifted to new streaming platforms, and it's going to turn, unlike that, they were typically local industries. Like, we know a lot of families who made a lot of money owning one of the television networks in Australia. Imagine owning one of those oligopoly positions in every country in the world outside of China. It is a totally global business. The global entertainment business is enormous, and it's going to fall into the hands of, I would guess, maybe 4 global players, with a few of them maybe being dominant, maybe Disney Plus, Netflix being another one. Apple's obviously having a go there. I wouldn't maybe put Apple, they haven't invested in the content as much. Netflix at the moment has slightly under 200 million global subscribers to its business. It's growing at sort of 20 to 30 million subscribers a year. So it's foreseeable in 10 years, it's going to have 400 million plus subscribers around the world. That's an incredible subscriber base. If they get their sort of annual or their monthly subscription to $15 to $20 a month, it's currently sitting just under $11 a month. That's a $70 to $100 billion US dollar revenue business. And maybe they end up with costs of $50 billion for their content, plus the technology costs and the hosting costs and the marketing costs they would have. That's a business earning $20 to $50 billion pre-tax a year. And it's probably going to be growing still in the double digits once you take pricing and future subscriber growth into account. This isn't just a business in 10 years, this is a 30-year play. And it's all very hard to see once you get into a sort of a cloud-based streaming business of what's going to replace it. You could get it augmented with new platforms in virtual or augmented reality, but still you could stream it straight off. That's just content going into a device. And these companies have massive advantages because what they're doing is they're investing in the original content. Netflix is probably going to spend nearly $14 billion this year. In a few years, will be spending $20 billion a year on content. That content stays on the platform and they own it. And because everybody has their own, it's not like going to Channel 9 where you're all watching the same content. Everybody has their personalized content with artificial intelligence enabling recommendation engines. Plus you've got your friends telling you stuff, what they've watched. You can constantly be entertained, and therefore people won't switch it off. And at the cost of it compared to alternatives in pay television, it's very, very cheap. You just remember, we used to spend $10 to go and rent a video. And now for $20 a month, you can have 4 people in your family watching it in different houses at the same time in an unlimited capacity with almost insatiable content. And it's global content. It's just not local content. It's just a global content. It's global local content. So they're producing content in Spain and India and Italy and Australia and the UK to make this highly, highly relevant. So you don't have to, this is a long-term investment, but this is going to be one of the dominant entertainment platforms, and there'll be a few others in the world that will be producing enormous cash flows and growing for the next 30 years. It's quite clear where the winners in the game are most likely to come from. Now, it wasn't as obvious 5 years ago, but now it's becoming obvious as it's a scale game that's getting played out.
Okay, great. Now, Hamish, we're on the halfway point. I'm going to keep my promise to the viewers that we'll get through as many questions as we can. My last question before we go to all these viewer questions is, what's something you've enjoyed reading, watching, or listening to during 2020, given we're on the streaming conversation?
Yeah, well, while we're on sort of politics, there's one thing I really enjoyed watching, and it wasn't because of the political side. It was a series. It was a 3-part series on SBS recently called Hillary, and it's still on their streaming platform. And it was obviously a program on Hillary Clinton, but what it really hit the nerve is the progress that women have been making, and how difficult it has been and painful it's been for some of the women like Ruth Bader Ginsburg and Hillary Clinton, and what they've been through And it's just extraordinary. And I about the challenges women have had of sort of getting equality in society. And whatever you think of Hillary Clinton, I give her enormous credit for advancing that ball. And, if you've got a daughter or anything else or a wife, the fact that we're still even having this discussion of equality of women in our day and age, and just how much some of these women have fought for that position, which is their human right. It's a travesty that we're still even having this discussion, as I say, in this day and age. If you haven't watched it, I'm not saying it's a political thing. I'm not recommending it for a political statement, but if you've got a daughter or you've got anybody who's interested in sort of just basic equality between men and women in the world, I just really enjoyed it. And I was surprised. I didn't know I was going to enjoy it so much. And I've recommended it to a few people, and they've all come back to me and said, wow, that was something I wasn't sort of anticipating.
Good stuff. Thank you for sharing. All righty, let's get into the questions. Keith has asked, and this is a popular question again, what will the election do to the relationship between the Australian dollar and the US dollar? Obviously a topical question for a global investor.
I'll say I've got no idea. I really don't know. There's so many forces that impact on currencies. Obviously, the Reserve Bank, and they were quite explicit. Glenn was quite they were quite explicit at the Reserve Bank. Part of the reason they've gone to quantitative easing and reducing interest rates is to try and put a lid on our dollar for export competitiveness. But every other country, this is kind of a race. Every other country is lowering their interest rates as well. So when everybody does it, what's the net effect on your currency going to be? It's very, very hard to call. Is the election going to make any real difference between our dollar to the US dollar? If you've got a dart, I'll throw it at the dartboard. But beyond that, I just wouldn't know.
Okay, we'll move on. So the challenges that Trump's throwing around the election result, do you think that could be a drag on the markets?
It could only be a drag on the markets if we generally get down to one contested state. If the issue was, and it was always pre-election, that if it really came just down to Pennsylvania, and it was like what happened in Florida in 2000, and it was that one state, and it came down to a few postal votes, and it was the decision around the accepting of postal votes after the election, and that was a genuine legal question, then I think markets, and you could start to see riots and people on the streets. It looks like that's going to be an unlikely situation. I don't think it's going to come down to a few postal votes subject to Pennsylvania, but it could. If Nevada goes to Trump, and it depends on exactly how these last 700,000 votes in Pennsylvania flow, there's a possibility. There's a possibility of that. So if it just comes down and we're down to one state and it's Pennsylvania, and it turns out to be super tight on what was counted, and there's a legitimate dispute around those votes received after election night in Pennsylvania, that's a real question, to be honest. It's not whether the vote should be counted or it's not. It's whether or not they had the ability to extend the acceptance of ballots after election night for those 3 days. And it was those 3-day votes that determined the outcome. You could get a lot of sort of civil unrest and things in America, and the markets wouldn't like that. But hopefully the Supreme Court would determine that outcome, either refer it back to the Pennsylvania courts as a state matter, or determine that. But you could get an ugly situation for a short period of time. But it will get determined, and we will get a president. Mm-hmm. And even if it was determined and they'll count it and Trump gets in, I don't think there's a lot to worry about. So if it happens, all I'd say is go and have a cup of tea or grab a whiskey or something and ignore it.
Tune out for a while.
Just tune out for the week or 2 weeks what it takes. If it happens, the markets may get nervous. Your televisions may look like there's civil riots in America. It will probably be exaggerated. But at the end of the day, an outcome will be determined by the legal process. And then there will be a president of the United States, and we will move on.
Okay. Question, I feel like you addressed this in our opening discussion, but will control of the Senate impact on the market's response to a Biden win? And I think your view is that the current status quo actually looks like the Goldilocks scenario.
Yeah, I do think it's a Goldilocks. And I always thought that was the biggest question in the whole election. I always thought it was the Senate outcome was the thing that was really the market-facing view. And I guess we've seen overnight that that's exactly how markets have voted, on the expectation that the Senate's in Republican hands.
Yep. Okay.
There's still an off chance it could end up 50-50, by the way. So we're not completely out there. There is a runoff beginning of next year. It just depends how there's 4 Senate seats still out. It looks like the Republicans are heading 3. So it looks like Republicans are going to hold that. But if it turns out that it would be 50-50, then the markets may start reevaluating the situation.
Okay. This has been a really popular question from BK. Hamish previously preferred US shares with expansion plans into China, for example, Starbucks. Does he have any plans on investing directly into China, and down the track, any plans regarding India?
Well, in relation to China, we have materially increased our exposure to China, and we've really been doing it to diversify our risk. He's absolutely right that we had invested in their businesses like Starbucks. We still are one of the major investors in Starbucks. They've got 4,700 restaurants in China. They're opening 600 restaurants a year. They've got a massive long runway in China. They get 80% plus return on their capital from a new restaurant. It's a fabulous story, but there's a lot of geopolitical tensions between China and the United States. They may not be as volatile under Biden, but they're not going to disappear. Therefore, you don't want to have all your exposure to China purely through US brands. And we really believe in the continued economic rise in China. We may be wrong, but we, rightly or wrongly, we believe we want to invest where the growth in the world is. That may be technology platforms or whatever, but China is a very important place of economic growth on the consumer side. And we now have about 15% of the portfolio in Tencent and Alibaba. Plus we own Starbucks, plus we own Yum Brands, plus we own Estee Lauder, plus we own LVMH. So we've materially increased our exposure to China, but we would argue we've increased our exposure through very different risk vectors, through luxury companies in Europe, through cosmetics, which aren't visible on people, to very visible brands like Yum Brands and Starbucks. Yum, of course, owns KFC and Pizza Hut in China, but now we're through 2 of the best companies in the world, which are Alibaba and Tencent. So China's a very important place to get right in investing in the next 10 to 20 years, but there's risk there, and you want to diversify that risk in how you approach it.
Okay. I guess another question on this one's from Bruce. With Chinese sanctions on Australia, should SMSF investors put more money into national equities? I know that sounds like financial advice, which is not what you're giving, but I guess a view on the implications of Chinese sanctions on Australia.
Yeah, well, I'll split into two questions. In terms of people's case for having offshore investments, Australian equity markets make up about 2% of the world's global capitalisation. So, if you've got most of your equities invested in Australia, you're obviously ignoring 98% of the universe. And when you look about where the ball's headed in the world, and what's going on, you want to be invested into e-commerce, you want to be invested into digitalization, you want to be invested in the cloud, you want exposure to China, you want exposure to where the puck's going, where the ball's going in the world. And we don't have a lot of companies in Australia that are in some of those critical areas. So I'd argue that you want part of your portfolio exposed to some of these big global business themes that are occurring. One of those I mentioned was China. I would argue the sanctions on Australian business is a short-term issue, I would hope. I think we need to have a much better national dialogue about what our national interest is. We have a security interest and we have an economic interest. At the moment, the security interest seems to be dominating our approach to China over and above our economic interests in China. And, they're the largest source of foreign students in Australia. They'll be the largest source of tourism in Australia. They're massive consumers, of course, agricultural products, massive consumers of natural resource products in Australia, very, very important for our economic security. And I'm not underplaying the national security interests at all. They're real. I was describing them before. These tensions aren't going to go away. But we as a country need to find a balance ultimately here. And I'm directly answering your question. Would I be that concerned about not owning a wine company because of the sanctions? I suspect we'll end up getting a balance because our economic interests, and this is what China's trying to do, it's trying to remind us to think about our economic and security interests. And I suspect they will keep taking action until the dialogue in Australia starts balancing the discussion. And it shouldn't only be business who leads this discussion nationally with politicians. It should also be the tourism sector. It should be the hospitality sector. It should be the agriculture sector. It should be the education sector. And of course, it should be the business sector as well. But everyone's too afraid to speak out because they're afraid of offending the government. I'm not afraid of offending the government. I believe in our national interest, and I believe you can protect your economic security and your national security at the same time. And I hope there is more people who are prepared to speak out in the future, because I'm afraid that the national security, and these I sat on FIRB, so I'm not underplaying the national security issues, but you know, the China bashing topic is popular in the focus groups. And then so it's easy from a political point of view in short-term election cycles to play up where we're really harsh on China, but it may not be in the long-term interest of Australia of getting this balance wrong. And I know I may not be winning all the popular votes here in saying it, but someone has to start speaking out and actually talking. And we at Magellan, we have no Chinese customers. I'm not talking about it because somehow Magellan's going to get a benefit. If anything, we want to invest Australians' money into China and make money from China, not because we're selling products to China. China doesn't pay us anything. We have no Chinese clients, but I feel strongly about our sort of what our national interest is. And our national interest includes our economic security and jobs in the future, as well as I don't think China's about to invade us, by the way. So having a total security debate without an economic debate, I think is not the right course.
A quick follow-on question. Has your view evolved as you've become more engaged with China through the investments that you have at Magellan?
Yeah, it has evolved. You know, obviously I got exposure to this debate at FIRB, really what was our national security. And there were certain, there were industries we debated at FIRB that we felt that you want to restrict Chinese investment into them because they could have been telecommunications or electricity grids or very, very core resources, resource deposits. But there are other industries where we felt we should be welcoming foreign investment from Chinese investors and helping that. But ultimately it was a government decision at the time. You know, it was only an advisory board. Has it been evolving since we've been there? We spend a lot of time going to China. And I think what misses from the debate, and we get very caught up with the political debate in the Communist Party in China and human rights and everything else. But there's been 800 million people brought out of poverty in China. When you go there and you read our media about all the repression of everything else, and you go there and you see the people and the economic prosperity in China and the quality of the infrastructure and the schooling systems and the healthcare system from a country that was a third world country 40 years ago, and we lecture them that they've got everything wrong. Have they got everything right? No, they haven't got everything right. But you know, I think there has been amazing progress for the Chinese people as well. Maybe not on every single human right we would naturally want, but are the Chinese in aggregate much better off than they were 40 years ago? Yes, they are. And because of the economic prosperity, you can see the investment opportunities as well occurring in China. So yeah, going there, participating gets us to see the opportunity, but also gets us to see a balance that it's not all bad either about what's happened in China.
Hamish, we've got 68 questions to get through in 14 minutes.
Well, you can do one of those rapid fire ones.
No, we'll try and keep moving through a few more.
I have to have a quick drink of water getting through 68.
Do a couple of star jumps. Alrighty. Question: inflation. Where do you see it heading?
Yeah, I think for the next 5 years, inflation isn't the problem. We've got a massive excess aggregate sort of supply in the world. We've got shortage of demand in the world because we've got probably an economic downturn. Therefore, I don't think we have any true pressures on inflation in the next 5 years. But we are in a massive experiment of taking on huge fiscal deficits and printing money now. And Australia's joined the party with its quantitative easing program. Ultimately, are we going to cause monetary inflation in the longer term? That is a great unknown. And inflation down the track, which would cause interest rates to rise, is a major negative for asset prices in the long term. Will it happen? Won't it happen? I don't know. But it should it be on your agenda in the 5+ year time frame? Should you think about that, of how you structure your portfolios? Yes, you should, and it's something we give an enormous amount of thought. But it's not something people should be panicking about in the short term. But it is a long-term great unknown.
Okay. On the topic of stimulus, what are your thoughts on the possibilities of a US stimulus package being passed through post the election?
I think they're high. I think they're high, but I think they're going to be much more negotiated. I don't think they're going to be up at the $3 trillion level, because they're going to have to agree with the Republicans in the Senate, assuming it's Biden in the White House. But I do think there is a political desire on both cases that they don't want to be blamed. You know, you've got a shutdown occurring, you've got a second wave occurring in the United States. You've got states under enormous strain occurring. Mitch McConnell has already come out today and said the first thing he wants to get through, and of course he's the Republican leader of the Senate, is a stimulus. There's going to be a lot of argy-bargy what's in that stimulus. But before the election, there was a huge amount of politics to look like you were doing something, but no intention to give Trump a win. I think the incentives change. I do think we will get it. I think it's going to be scaled down from what would have happened had the trifecta occurred to the Democrats. But yes, we are expecting a stimulus. If we get gridlocked and there's no stimulus, the market's not going to like that.
Hamish, a question from John around the Republicans retaining control of the Senate, which I know has been a topical point for us today. What does it mean for the Democrats' clean energy plan, and therefore, well, I guess part one, and part two, is there an implication for oil, the oil price, and do you see weakness there as cyclical or structural?
Yeah, look, what it means for the oil price, I really don't know, because the transition away from oil is a very long-term issue. I think oil's much more going to be driven in the short term. They're not going to suddenly ban fracking or something in the short-term issue. I think it's going to come down to Saudi Arabia and Russia, and actually the demand for oil in aggregate. What's going to happen to their plan? Well, I think clearly you're going to see executive orders and things that are going to reverse some of the Trump executive orders that will go back towards the Obama orders. It's going to put more pressure on clean energy in the economy. Are they going to get a massive expenditure bill forward that it's going to get subsidies and things from the federal government? I think Republicans may well do that. But a lot of this happens at the states, and a lot of this happens at utilities. And the one thing I would say, whatever your view on this is I'm an optimist on climate change. And why I say that is I can see the economics now working strongly in the replacement of fossil fuels in terms of energy generation in the world. We're crossing over the points of economics now. And there's now proper incentives to do this. We don't need carbon taxes and everything to bend the point. The economics are now starting to stack up. Biden would obviously like to accelerate that with a few more subsidies and direct investments by the government, but it's already happening. I think he'll change some of the rules in terms of by executive order. Is he going to get the whole plan through? I would be without control of the Senate. The answer is no. It's going to be more scaled down, but it's going to be moving in that direction under that. But you're going to have the Republicans are going to have a much more of a say of what the money's spent on. And that's a check and balance probably isn't a bad thing either.
Yeah. Just a follow-on question with the evolution of that energy market. Does that become an investable opportunity for you?
Well, the one thing, well, we're indirectly invested. We've got a meaningful position in US utilities. They're spending enormous amounts of capital expenditure on what they call the Steel for Fuel campaign, where they're effectively investing in solar and wind, and they're no longer paying the fuel. So they're actually putting massive capital investment into their grids. And believe it or not, power prices are not going up, because they get a return on the capital, but the return they're getting is effectively by not paying the fuel costs. They're not paying the gas and the coal prices anymore. That's where the economics are switching. And they would like to invest faster, but it's really about how fast they can invest without affecting power prices. The one thing I'd say, James, is always be careful. You know, ESG is a very interesting topic, and ESG can help you identify where the ball's headed. And we always want to go where in the direction where the ball is headed. We want to invest where the winds are blowing. But just because the winds are blowing in something like clean energy, that doesn't mean you're going to make money in clean energy. You know, had you invested in the airline industry, 120 years ago when Qantas was formed, in aggregate, the whole airline industry's never made any money, but it's grown over 6% per annum for 120 years. The same in the auto industries, and the clean energy industry is going to show a lot of growth, but there'll be a lot of disastrous places to invest in that space. So what we try and do is we like identifying something like clean energy where the winds are blowing, mind the pun, there, but then you have to find the right investments, and that's where the skill really comes in. Where are the places in the value chain where the industry structure and the return on capital is attractive, that you're really going to make money by putting your capital there? You shouldn't just put capital there because you get a feel-good factor or because you think there's going to be growth. Growth of itself doesn't create good returns. You have to have the right return on capital and the right industry structure plus growth, and then you're talking here.
It was interesting, you made a comment when we were talking about streaming earlier, that it's now clearer who the winning players are going to be, and perhaps that comment relates to this industry as well for you.
Yeah, and there will be winners in this industry, but Tesla is one of the classic cases in point. Musk has done an incredible job in demonstrating to the world that an electric car can be a very, very viable and a very good product for people. But at the end of the day, this isn't a platform he's not going to own every charging station. They'll end up coming with a common charging point, and there'll be no network effect. It will just be like a gas station here. And manufacturing an electric car isn't that hard, and there'll be lots of manufacturers of them. So why is electric car manufacture going to be any different to standard car manufacturing in the long term? And that's been a crap industry. But people because he's been a messiah and has identified this, people have waded in and not really thinking about what the long-term economics of a highly competitive industry is going to be. Are we going to have a massive growth in electric cars? Absolutely. We may have a massive growth in hydrogen-powered cars, by the way. So electric cars may be the Betamax of the industry. Ultimately, it may, Betamax was a better product, but it was actually VHS in terms of what took on that, and ultimately it got replaced. Whilst I think it's electric cars is going to have enormous growth, and maybe hydrogen-powered cars, the manufacturers may not be a good place to be invested. But let's see.
Hamish, we've got about 5 minutes to wrap up. There's no chance for me to get through all these questions, so I'm just going to see if we can knock over a couple more of the top rated before we wrap things up. A question from Grant just around gold, and I guess, do you see a place for it given the massive growth in money supply?
Yeah, it's a very interesting question. I would regard gold as an alternative to currency, and it was good that it was framed in terms of the money supply. So I think you should view currency as gold as a diversification from your currency risk, particularly with the printing of money. Should it replace stocks in your portfolio? Gold doesn't produce anything. It doesn't produce any income, doesn't produce any cash flow or anything else, but neither does fundamentally if you're holding cash in your wallet. It doesn't produce anything either. So as an alternative to currency, I think it's a very valid thing to be considering for diversification in your portfolio. But should you be replacing your equity portfolio with gold? I think think equities are going to materially outperform gold in the long term, but gold may outperform holding money in cash in a zero interest rate world.
Okay. On cash, I think last time I looked, you had around about 9%. Any plans that may have changed? Correct me. But any plans could you give us an idea of where that cash balance might head?
Yeah, look, if I go back to March this year and probably into May, we were up at 18 or 19% in cash. I think today we may be down 11 or 12% in cash. We have come out of our cash. And as this has progressed, particularly the virus and the ability for systems to handle lockdowns, and particularly with the stimulus and interest rate environments and what we've seen from central banks, has made us more constructive on risk. And we have made some selective investments in the last 3 or 4 months as that's been occurring. But we're still cautious around, we don't know the outcome of the vaccines. We obviously see that we've got economies have probably been more resilient. We've had massive stimulus, but still we've still got this unknown around the vaccines. And the thing that would probably make us more constructive on risk is just having greater clarity around we don't punt on those outcomes. We just don't know. So we're waiting for that before we would then make the next reassessment.
Okay. Last question before we do some concluding comments. This is from Robert. On a previous webinar, Hamish shared his views on the importance of having exposure to the Chinese consumer via technology platforms which drive e-commerce activity. Platforms like those owned and operated by Alibaba. With the CCP having now put the brakes on the dual listing of Ant Financial, what, if any, ramifications does Hamish see as this having on the growth of the Chinese e-commerce sector?
Yeah, we don't think it really has any implications on the growth of the e-commerce sector per se. Alibaba is fabulously well positioned. A few others are well positioned. Alibaba controls about 16% of all retail in China. There's $1 trillion of goods sold on their platforms. The two big platforms are Tmall and Taobao in China. Just incredibly powerful businesses that have massive structural advantages. That's really not where the regulators are focused on. There are two issues that happen with Ant, and Ant's a very good business by the way. One was Jack Ma and his ability to do things that really irritate the leaders of China. He did it a number of years ago. He owns a South China Morning Post, and there was an article that was very critical of the leadership in that. And in the end, he stepped away from leading Alibaba. Now, just before the Ant IPO, he was on a platform and made some pretty stupid comments that were very critical of the regulators around the banking system versus the fintech system. And I think that really caused the pulling of the suspension of the IPO. I think it's ultimately Jack Ma who's going to. It's going to be interesting to see what Jack's position is when the tide settles on this. But what the PBOC has said on regulation of the payment side of it here is very, very sensible. By the way, they're effectively saying that Alibaba is effectively originating massive amounts of consumer loans that it tenders out to the banking system. It's a very efficient transmission mechanism of getting credit out to consumers in China, which is very important for economic growth. So they haven't said we're going to stop that. But they've said we're concerned that you could be spreading the credit too fast or into people who can't afford it. So we want to cap the amount of loans that you can lend to an individual to sort of $30,000 per individual, or 50% of their annual income. And that's really so we don't create a financial disaster of sort of the subprime crisis that they had in the United States. And the other thing is, if you're going to originate and it's your algorithms that's going to do all the credit checking, some of it overlaid with banking systems, we'd like you to have some skin in the game. So they're asking them to retain part of the balance. Regulators around the world have required that in places like the United States when you're originating loans, that they didn't want them all just being sold into the capital markets. Here they're being sold into the banking system, some skin in the game. So what the regulators are suggesting, I think, are very, very valid regulatory responses to an evolving industry, and Australia would be doing the same thing. So just because China's looking to regulate and put in sensible changes, you don't only say, oh, you don't invest in China because their regulators are regulating an industry. These payments industries get regulated all around the world. And I would say China's approach is very, very sensible that's occurring in relation to that. The pulling of the IPO at the abrupt moment it happened, I don't think was so much about that. It was really around Jack's comments here. That will get sorted out, and it will move on, and these companies will keep growing. It's probably in a way that we really don't see it happening in Australia. We don't often just take out the chairman of BHP, but sometimes there's political pressures that occur. We just had the head of Australia Post get taken out in a fairly abrupt manner. You're just seeing a different version of it happening in China.
Yeah, great. Well, Hamish, we're going to wrap things up there. For all of the people on the call, I just want to say thank you very much once again for tuning in. We really appreciate your time and all the questions. We tried to put a dent in them. We've still got 70 or 80 odd questions outstanding, but Hamish, I think you've done a really great job there. I was just hoping you could just summarise that one sentence again for those people that joined a little late. I know the US election is super topical, but you gave us your Nirvana description. If you could just wrap us up with that view on the election once more.
Yeah, I'd say the election where it's landed is the Nirvana outcome for markets, and really because there's a very strong check and balance. Whoever wins the White House, Congress is split. You're going to have the lower House of Representatives with the Democrats. It's very likely you're going to have the Senate with the Republicans. That's a very strong check and balance. You're going to get no radical changes. You're going to get no increases in taxation. You're going to get no radical reforms occurring through, and the markets like that outcome. It looks like Biden is probably going to get up. I think that's likely. I'm not making a political view. I think that's just where the facts are at the moment. I think the markets may slightly prefer that with this check and balance, because you may get a calmer waters around the sort of foreign policy or the way foreign policies are conducted. But if it flips and Trump's the president, I would still say there's that strong check and balance, and the markets will be fine whichever way the outcome now happens.
Okay, great. Well, Hamish, thanks again for the time. I really appreciated this opportunity to speak with you at such an interesting time. And for all of those people viewing, a replay of this webinar will be available on Livewire, and we'll also be writing up an article summarising some of the key views that Hamish has shared with us all today. So thank you all for joining, and safe investing. Stay safe out there. Thank you all.